Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Morgan Stanley Direct Lending Fund's President, Michael Occi. Morgan Stanley Direct Lending Fund, or MSDL for short, seeks to achieve attractive risk-adjusted returns by investing primarily in directly originated senior secured loans issued by U.S. middle-market companies. On the show, we discuss why investors should consider an allocation to private credit, what explains the significant market share growth of private credit in financing buyouts, MSDL's defensive approach to lending with a focus on first lien loans, his thoughts on the current market environment for private credit loans, and more. A point of disclosure, Accelerate's private credit ETF, the Accelerate Diversified Credit Income Fund, INCM, on the TSX, invests in the Morgan Stanley Direct Lending Fund. So with no further ado, here's our show on trends in private credit with Morgan Stanley Direct Lending Fund's President, Michael Occi. All right, I'm pleased to welcome Michael from Morgan Stanley Direct Lending to the show. We're going to chat about private credit today, a very topical subject amongst institutional investors, the private wealth channel, a lot of investor interest, capital flowing into the space, and rapidly developing area, whether it's loan structure, deals, liquidity. We're seeing so much evolution and innovation in the private credit space, and just the amount of growth and eyes on the asset class is pretty incredible. So happy to have a real expert here. So Michael, what are your thoughts on kind of the state of things within the private credit space? And as you discuss that, if you could tie in Morgan Stanley, your private credit platform, discuss that. And then more specifically, where we're going to focus today is the Morgan Stanley Direct Lending Fund, which, for the sake of our listeners, we're going to refer to as MSDL. So Michael, off to you.
Thank you, Julian. Honored to be here with the Accelerate team to have an opportunity to talk about the platform, the business, the market. We do appreciate it. Thanks to all the listeners as well. As you'd expect us to say, we're quite bullish on the state of the private credit market, and specifically the direct lending market. It's a business that has grown across the industry at a pretty impressive clip. There's a lot of drivers behind that. I think the quick synopsis is it's a couple of main drivers in the demand for direct lending solutions from the borrower in the sponsor community, and then its appetite from investors who want access to direct lending just due to some of the attractive attributes of the product, be it through BDC structures or other private funds. We have had a business in alternatives for about 40 years. Specifically, private credit was a strategy that we founded back in 2009. And the direct lending business has grown, like many of our competitors, at a pretty impressive clip in the last handful of years. We have a global private credit business here at Morgan Stanley of north of $30 billion in fee-paying AUM. The direct lending strategy that is focused on sponsor-backed middle market direct lending in the United States is about $21 billion in committed capital. We have a host of different products underneath that across the spectrum of BDCs and other private funds, including SMAs. And we're quite pleased with the performance of these products and, more importantly, the number of investors that we've had an opportunity to touch, be it traditional LPs, institutional, retail alike, and investors in our public BDC, the Morgan Stanley Direct Lending Fund.
And so how is your approach to origination and investing differentiated amongst your competitors, especially and as well the portfolio that you have at MSDL? How would it be different than some of your private credit peers?
Yeah, Mike, it's similar and unique. I think the structural of our business is similar in the sense that it is a third-party capital managed business whereby we have a dedicated team here in investment management. The entirety of the investment committee are investment management professionals with the goal of producing good risk-adjusted returns for our LPs. So it looks similar in structure to other third-party managers. We think the team is top-notch, about 74 professionals, the majority of whom are on the investing side, the senior-most individuals having been in the business for north of 20 years, 25 years roughly of average experience trafficking in the direct lending market, covering private equity firms day in and day out. We cover approximately 450 private equity firms directly on our team. We have offices in New York, Chicago, LA. We think it stacks up very well to some of the other branded managers out there in the marketplace who may be even larger than we are from an AUM perspective. But what makes us different, even though that's the foundation and the investment infrastructure, is that we're housed within a global investment bank. MSIM is one of the firm's three main divisions, with the institutional securities business and the wealth management business being the two others. And the reality is that even though we're not reliant on other pockets within the firm to source transactions, that is really the engine, those senior individuals originating transactions on our team. But we do have a parallel relationship in many of these private equity firms that we cover sitting in the seasoned investment bank. We have other touch points that emanate from our fund of funds business that sits within alternatives in MSIM, where they're making LP commitments to many of these middle market GPs. So in summary, you have the core of our origination or sourcing model that looks similar in structure to the independent, more pure play firms. But because we're part of a global investment bank with other tentacles into these private equity firms, it may be the case that for certain sought after investment opportunities, that private equity firm may be more apt to get their capital from us because there's something else they may get from working with Morgan Stanley, be it sell-side M&A flow, capital markets expertise, an LP investor opportunity. And that gives us an edge. And I think it's one of the reasons why we like to think that we punch above our weight from a scale point of view and are visible in the market, notwithstanding the fact that we're just north of 20 billion in AUM.
Certainly, there's a tremendous amount of synergies across the Morgan Stanley platform, just having those relationships with private equity firms, whether it be on the M&A side, lending, things of that nature. And as we discuss private credit, we're typically referring to sponsor-backed senior secured direct lending, as you indicated, Michael. Now, with that, what may surprise many of our listeners is that private credit now provides 90% of middle market LBO loans. And there's been this significant market share grab of private credit versus the other sub-investment grade segments of the credit market, whether it be high-yield bonds or broadly syndicated loans. What do you attribute to that significant market share growth? Why do private equity firms prefer direct lenders to fund their buyouts?
Yeah, Julian, it's a good question. I would first start out by saying, save some of the volatility we've been witnessing in the market over the past month, driven, in our view, largely by some uncertainty out of DC, that it's helpful and constructive to see that all financing markets have generally been operating and functioning in a healthy way. We think it's conducive to M&A activity in general, even if it's come at the expense of maybe some spread compression across the board. But we do think over time the market share, maybe to say your question in a slightly different way, the market share for these middle market LBOs and other financings growing within the direct lending source of capital relative to other sources of capital, I think is driven by a few different things. And they've generally been around for a while now, but the adoption rate, to your point, has certainly increased. I think privacy is probably one of those characteristics where the private equity firm or the borrower has to deal with only a few lenders, small group of lenders, to go and underwrite that credit, rather than a big group, big syndicate of banks, to then go and syndicate that to many lenders, many investors thereafter. There is some structuring flexibility that the private market offers relative to the public market historically. So the ability to get, some unfunded capacity out of the gate has been one of the trademarks of the direct lending market. Certainty of financing, another benefit. And so it's really a combination of things that, has driven this market share growth. And, we believe will continue to drive, private equity firms to continue to prefer this market for many borrowers in this segment of the corporate landscape. It's not the solution for everyone. In many cases, the syndicated public market, even the high yield market, may be a more efficient source of financing, but for many, it has become, and we expect will continue to be, the preference going forward.
Interesting. Now, the other side of the market, if we look at investor demand for private credit, there's been a tremendous amount of growth there, a lot of demand. It's a popular asset class these days. Meanwhile, you look back 15 years ago, effectively non-existent, kind of when you guys were in your formative stage at the Morgan Stanley Private Credit Platform. Now, with that, what would you say are some of the main reasons driving investor and allocator demand for private credit allocations versus the other segments of the sub-investment grade credit market?
Yeah, so that's the logical next question, Julian. What's driving LPs to want access to the asset class? And, I think it's a few things. Historically, the volatility of funds that have exposure to direct lending has been lower than for some of the public fixed income asset classes, including BSL market and the high yield market. When you compare the nominal return relative to that volatility, it produces pretty good risk-adjusted returns that, I think has drawn investors to the asset class. From a retail perspective, there's been evolution in the structure itself, where you've seen the advent of non-traded BDCs, which give investors an opportunity to get access to direct lending with even more frequent income. And so, I think it's structural innovation, but at the core of it, it is an opportunity to get good risk-adjusted returns, maybe as a substitute for some of someone's public fixed income portfolio, correlations that tend to be relatively low as compared to some of these public market asset classes. And the historical experience from a net loss point of view has been pretty good too, when you consider the historical default rates, the recovery rates that are pretty robust. And so I think it's a combination of those things.
That makes a lot of sense. Now, you mentioned structural innovation. There certainly has been a significant amount of that. Some terms that you mentioned, non-traded BDCs, listed BDCs. Obviously, MSDL is a listed BDC, and you guys do run some non-traded BDCs on the platform. Would you mind chatting about that structure and what in particular makes the BDC structure ideal for private credit funds? Many of our listeners, and I think, kind of the investor population in general, aren't necessarily up to date on the BDC structure.
Yeah, Julian, good question. Maybe to break it down, we, by our sourcing, see about 3.1 trillion in levered AUM around private credit. About 1.65 trillion of that is direct lending, and you find about 25% of that AUM base in BDC structures. So with the balance being found in private GPLP funds, SMAs, what have you. And so, a meaningful segment of the direct lending fund base in asset terms, the evolution that we've seen really over the last handful of years has been more the advent of the non-traded product. The public BDCs have been around for, call it, 20 years. We were proud to be part of that family. I think there's approximately 50 public BDCs in existence. or in the company of some of the larger market cap variants. And, they are a natural home for these corporate loans. And that's thanks to some legislation back in the 80s as an offshoot to the 40 Act that had made it that way. They're tax efficient at the entity level due to them generally qualifying as regulated investment companies. The distribution profiles have clearly been one of those lures to the structure as well. From a reporting and regulatory point of view, we think that they offer investors some pretty good transparency into the underlying portfolio. There's a governor in terms of the fund level risk vis-a-vis the leverage cap, where most BDCs tend to run at leverage levels that are well below the 2x debt to NAV limit. We have a target generally in our BDCs, including MSDL, of 1 to 1.25x debt to NAV. And so there's a combination of things that fall out of the kind of BDC and 40 Act regime that we think give investors, good transparency around asset quality, and they generally offer investors a good opportunity, not just access the asset class, but enjoy pretty good returns from an income perspective.
And another aspect that we like is the transparency around the BDC structure. As public SEC filers, you get the 10K, the 10Q, get to take a look into the loan book and see where things stand. And speaking of that, congrats on the Q4 results. You guys are doing super well in the market. In contrast to some other players, we have seen some hits and misses out there, some running into a bit of issues around kind of specific sectors. I was wondering if you guys could discuss your due diligence approach to lending that helped MSDL sidestep some of the kind of small issues that a few other lenders have run into lately.
Yeah, I think I would start with the investment strategy and the competitive landscape. Kind of each has their own approach to the market, even if at times they all seem, or some may seem similar. First of all, the focus for MSDL is squarely on first lien senior secured loans. And, if you look at the portfolio mix, it is approximately 97% first lien senior secured debt. So the very top of the capital structure, LTVs that are in and around 40%. So tremendous equity cushion beneath us in the capital structure to really preserve the principal, or said differently, a lot of that principal would need to be eroded for our principal to be at risk. We're not going to get them all right, but having that first lien claim on the assets is a good principal preservation strategy in our view. We also seek to avoid cyclical investments, so we don't invest in retail, restaurants, or energy. And so you'll find for MSDL, approximately 95% of the portfolio is deemed to be non-cyclical. And you asked about diligence. Beyond that, I think we, like many of our competitors, have an intensive diligence process where our direct team here in Morgan Stanley Private Credit is doing some independent work, working with third-party expert networks, working with counsel, and then also having an opportunity to leverage the broader content-rich Morgan Stanley ecosystem, whether that is equity research, credit research, through the proper channels, maybe experts in a given field within investment banking or other groups. As appropriate, we'll also have an opportunity to leverage our experts on the private equity side. And so it is typically a 4 to 6 week process depending on the situation. And it's a process that has been purpose-built here within our alternatives practice to lend itself to, really diligence opportunities in the event that we're turning something down, hopefully give that private equity firm transparent and timely feedback in that regard. Those relationships are deeply important to our business. And then leaning on the firm where appropriate to further underwrite these opportunities in the best way.
And with respect to those private equity relationships that you mentioned, I assume that's another key aspect of your strategy is sponsor-backed lending. Can you talk about the strategy of focusing on sponsor-backed private companies versus other firms that would do non-sponsor-backed loans?
Yeah, other firms certainly do it. We do it as well, by the way, in strategies that sit alongside us, sit alongside our direct lending business. We have an opportunistic credit business that will do non-sponsored activity. We have other asset strategies within the private credit ecosystem here in MSIM that will do it. We're not allergic to it by any stretch of the imagination. What we found is, structuring these businesses with more narrow mandates has produced good risk-adjusted returns for us at vis-a-vis what we've experienced here in MSDL and our direct lending strategy. The non-sponsored investing tends to be a little bit more labor intensive. I think we have partnered with private equity firms who we've had relationships with for in many cases multiple decades, where we've seen them behave through cycles. I think where we've seen some weakness over this inflationary period in time in the last several years, we have seen some of these private equity firms support businesses that may be underperforming, and by delevering or through some other means. And so we like the strategy. We think it has helped to drive good returns for our business, but we do engage in non-sponsored activity outside of the direct lending strategy.
So digging into a little bit more into your credit underwriting philosophy, something that's been very topical lately over the last year or so has been payment in kind income, so PIK income. Right now, your percentage is around 2.6% compared to the larger BDC universe, up higher at around 7%. So you're below average on that, which is thought of as a good indicator in terms of the underlying portfolio's credit quality. But how do you think about payment in kind or PIK income, and how do you utilize it within your underwriting process?
Yeah, Mike, it's a great question. Clearly topical. We're not surprised to see PIK formation generally having increased in just given where asset yields or the cost of borrowing has come to over the last several years. It's something that we had kind of anticipated. The structural flexibility has existed for many years now within the direct lending ecosystem, and so as we've disclosed, albeit pretty contained in our portfolio, it's a mix of PIK that has emanated from deals that were originally structured as PIK and deals that have been amended to have some PIK component. I think the relatively low rate, as you defined it, the PIK relative to income, is a symptom of our strategy being more relatively selective. When you consider some of what I spoke to around the origination mousetrap and the reach we have in terms of the sourcing funnel relative to a capital base that is, while sizable, relatively contained at $21 billion, it gives us the opportunity to be selective. The typical EBITDA, if you just look at the median we disclosed for MSDL of $86 million, this is a part of the market we like. We have the ability to flex up and down, but our business is not about sourcing the largest transactions in the marketplace as a means to deploy dry powder. We're growing. We have visions of continuing to grow this business through the fund solutions that we have built, but the quantum of capital that we've had to deploy has been digestible within the context of our origination engine, and I think the lower PIK rate is one of several credit measures that do reflect some of the selectivity that structurally we've been able to maintain.
And there's another characteristic that really stood out to me is the fact that you led or co-led 90% of originations last quarter, which is very high. Now, is MSDL's origination engine one of your competitive advantages? Does that allow you to really high grade the investment portfolio and stand out amongst your BDC peers?
Yeah, Julian, I think for full transparency, we're proud of the statistic That's clearly why we've highlighted it. I think it speaks to the fact that while we're not one of the larger managers in the marketplace, we have good mind share with our private equity clients that has led to us getting a lead or co-lead role in many of the new platforms that we've taken on. I think to be totally balanced, what you'll find for some larger managers out there is that the proportion of deals they're doing that is agented is much higher than ours. That's not our strategy. I think based on some of the commentary I covered earlier, this business is not about sourcing and underwriting the largest transactions in the marketplace and agenting those deals. We want to have a seat at the table from a documentation perspective and real visibility as part of that lending group over the life of the asset. And so, I think the fact that the proportion is as high as it is, despite the asset base being, only 21 billion today, as I've said probably way too many times, is a symptom of the depth of the relationships that our senior team have with these private equity clients, and probably the brand intangible associated with the firm that we clearly benefit from.
That makes a lot of sense. Now, Michael, before letting you go, I did want to get your current take on kind of the future of the direct lending business with respect to the current dynamic. Because coming into this new administration, and as we've discussed, private equity and M&A activity really drives the direct lending business. And you haven't necessarily had the resurgence yet, perhaps we do kind of later this year, of M&A activity that many were sort of looking towards on one end, which affects spreads and capital deployment in the direct lending space. And then conversely, you have seen a bit of a resurgence in the broadly syndicated loan market, also potentially affecting supply and demand dynamics, whether it's capital deployment opportunities, competitive dynamics, or spread within the direct lending space. So just wanted to get your thoughts on, what do you think about M&A activity? How is that going to play out? And, competition from, whether it's a broadly syndicated loan market or other players within the space.
Yeah, Julia, maybe to go in reverse, the competition from the public market has kind of been there for call it at least a year now. And, we think while it may impact terms available in the private market, all things being equal, it's still a healthy fact pattern to see, financing markets functioning in a healthy way. M&A activity, just sheer volumes, to your point, have not recovered at the pace that we would have expected the end of last year out of the gate here in 2025. We, I think, are probably not alone in terms of the witnessing an M&A recovery here in 25 that is slower to start. As I alluded to at the very beginning, we would point to some of the uncertainty around tariffs, taxes, DOGE, that is hindering the willingness for some private equity clients to underwrite new transactions. And it's probably going to take us to take that community, and by extension us, to see that visibility before we see M&A pick up. So we continue to be bullish on it. What we've said is we're with more conviction of that happening in the second half of the year. And that is admittedly a delay relative to where we would have predicted things back in November, December of last year. We think that deregulation will ultimately be a positive tailwind for deal flow. Nothing has changed in terms of the wall of dry powder and the seasoning of funds in the private equity community that will likely drive M&A activity over time. But certainly some of the uncertainty here has delayed that pickup. But hopefully we'll see that in the not too distant future.
Yeah, and we agree with that sentiment. It appears like it's only a matter of time. You have just a ton of private equity dry powder. And then on the other side of the table, you have LPs that are waiting for distributions, realizations on some of those more seasoned portfolio holding companies. So hopefully this market volatility calms down a little bit and we can see a sort of Q2 or back half of 2025 resurgence in M&A activity. And we look forward to further updates on MSDL. Michael, I'd like to thank you for sharing the story today. Your insights on the direct lending space are super valuable, and we appreciate your time today. So thanks for coming on the show.
No, thanks very much for having me.
All right. Bye, everyone. Take care.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.